Hi, so today we want to talk about fixing your interest rate on your home loan. We've never had as many phone calls as we have over the last 2 weeks from people who are looking to fix their rates and lock in some low rates. And I wanted to talk about some of the points that they've raised and also what's involved and how it can work. So the first thing I've noticed is normally when we have someone rings us about fixing their interest rate, what their concern is they're concerned about interest rates rising, and if interest rates rise, then the home loan repayment's going to go up as well. So what they're looking at doing in that situation normally is going, hey look, I can lock in now so that I know what my repayments are and I'm basically safe if interest rates go up anymore. Now that's changed at the moment. So the phone calls in the last couple of weeks have been more around that people have seen that banks have reduced their fixed rates, particularly for the 2 and 3 year period, and they're saying, hey look, I'm paying a variable rate which is a little bit higher than that, and maybe I could be better off if I fixed my rate, and how I might, that might be better for me in the medium to longer term. Now, there's no economics conversation talk without a good chart, so we're going to have a little bit of a chart for you today which we hope helps explain what we're talking about. Alright, now the first thing is at the moment with those clients who are looking at fixing rates, a lot of them at the moment are variable. Alright, so they've got a variable rate at the moment and they're paying around 3%. Okay, so that's what they're paying at the moment. And when they look online, okay, what they're seeing is that with their bank, they're offering rates that are in the lower twos. All right, so when I say that, I'm talking about 2.2, 2.3%, and they're thinking, well, if I'm paying up here and I fix, and instead I'm paying down here, then I'm saving that bit in between. So let's say, for example, we work with someone who goes and fixes their loan for a 3-year period. All right. Now, what's actually happening is it's important to remember where the bank's coming from on this and how the bank thinks about this as well. So the banks aren't a charity, and as we know, banks are mostly doing stuff to make money, all right, and to stay really profitable. So whenever a bank is offering you a rate, it's important to remember that they think they're going to win at that rate. So if you take that out, they think that they're going to be ahead by you fixing. So at the moment, with the way that rates are, and banks know a lot about interest rates, so what they're thinking that's going to happen is that with the variable rate, if you stay variable, the bank is thinking that that rate is going to fall at some point in the next couple of years, and that your variable rate would actually be lower than what you're paying on the fixed rate now. So where that's important is if you go and choose to fix your rate, it's important to think about that, hey, while I might be paying less in the shorter term, like up front, so I'm paying down here instead of up here, but be prepared for the fact that maybe towards the end of that loan, it could be in a situation where you're paying a higher rate on what the variable rate is at that particular time. And that's where banks win, and that's where banks make their money on that, is the fact that at the end of it here, that the variable rate is significantly lower. Now it's going to change, everyone's obviously in a different situation, and the figures and fees and stuff are going to vary between people, but that's how it kind of works on a whole scale level, and we hope you find it useful. And if you'd like to talk about it for your own personal situation, don't hesitate to get in touch.